Good morning, ladies and gentlemen. Welcome to Centum Real Estate financial results for the year ending March 2022. It's been a busy and productive year. We present to you solid results generated by a strong team. We'll go through the financial results. I'm joined by Solomon Zomo, who is our CFO, and my name is Kenneth Mbaye. We'll go through the business performance and then the financial performance, the outlook, and question and answer session. As we progress through the presentation, please feel free to type in your questions. We'll start with the business performance. So looking at Centum Real Estate at a glance, it's a 40.8 billion shilling business with assets spread across 4 subsidiaries. Vipingo Development, which has a land bank of 10,000 acres and a pipeline of 1,400 residential units with assets of 13.6 billion shillings. Palmarina Estates, which is in Uganda with a land bank of 389 acres, a pipeline of over 800 residential units with assets of 13.6 billion. Centum Development Kenya, a purely residential development business in Nairobi with a pipeline of 3,000 residential units and assets of 2.4 billion. Then Uhuru Heights, which is a residential development business with 400 units under development with assets of 2.3 billion. The business has a credit rating. On the strength of that balance sheet, we're able to raise our own debt, and every subsidiary has an independent board. Looking through the business, we've had a 7-year journey of setting up construction-ready mixed-use developments spread across East Africa. We have 3 master plans. We have a 5-stage development process: acquire sites in strategic locations, do master plan development, and then attract third-party capital at each development level. The first 3 stages ordinarily take 3 to 5 years. And then now the 4th and 5th stage is where it's a monetization stage. And we've recently done that. We are developing a number of residential units across all the 3 master plan developments. Looking at the year that has passed by, as I said, it was a productive year. In terms of sales, we have cumulative sales of 14.8 billion shillings. Year-on-year growth in terms of units sold. On average, we sell 400 new units. With the year ending 31st March, our total sales was 1,739 residential units. It's a cash generating business. We pre-sell and collect customer deposits. Within the year, the cumulative sales collection was 6.6 billion. In terms of new cash collected within the year, it was 2.8 billion, having a year-on-year growth. We have development rights business. The total value of the current pipeline with signed sale agreement is 8.2 billion. We crossed sales of 1.7 billion last year, bringing the total pipeline to 4.2 billion. We primarily run two business lines: sale of residential homes and sale of development rights. The sale of residential homes business is demand-led. For example, the annual supply in Kenya is 50,000 units against a demand of 250,000 houses. We are playing our role in bridging that housing gap, meaning the demand is greater than supply. It's also a high growth business, given the population growth, rapid urbanization, and the shrinking household size that has been driving the affordable and mid-market growth. It's capital right, as I've previously mentioned. We pre-sell the houses. Customers pay deposits during the construction duration. So those deposits are utilized to fund projects. So the capital requirement for this business is not much. During the year, the cumulative cash deposits mobilized by the business 6.6 billion, with a total sales value of 14.8 billion, meaning 8.6 billion will be corrected in subsequent years. Of all the units that are under construction, 66% have been sold and cash corrected. Then the next slide shows a summary of our cash corrections. During the year, we corrected 2.8 billion in new cash deposits. The split between the projects, we have high-end, mid-market, and affordable market. Between mid-market and affordable market, the cash correction was 80%, with the balance coming from a high-end market. The second pillar is still residential units. We've had a year-on-year growth in terms of the new number of units sold, 400 units sold. Last year, we completed construction of 600 units, of which 300 units were recognized on the P&L. Of those 300 units, the revenue generated was 1.8 billion, meaning there is a growth every year since we started the business. We also support the investors who have bought units within our residential developments. We've currently set up a rental portal where potential tenants can just lease out their units, and the investors see the uptick. Generally, between our projects across East Africa, the occupancies are increasing. We are at 30% occupancy and growing on a month-to-month basis. Then the development rights business, we have a unique master plan with infrastructure in prime locations. These master plans are difficult to replicate within our primary catchment area. That business helps Centum Real Estate generate cash. And within the year, we sold development rights worth 1.7 billion. That is what was crossed. The cumulative total sales from development rights is 4.9 billion. The cash generated from this business is utilized to fund the residential units construction and meet any debt obligations that arise within the year. During the year, we're able to sell 836 acres, generating cash of 1.7 billion, and we continue to see increasing demand for our master plan developments from third-party developers. In terms of construction progress, 4 projects have been completed and handed over across East Africa. A number of projects are scheduled for completion within this financial year and the next financial year. In total, we'll have finished 2,292 residential units. This shows a recently completed project in Nairobi, Riverbank Apartments. This shows Roft, the residential unit, a high-end product. on schedule for completion at Two Rivers. This is affordable housing project, Mzizi, within Two Rivers. The first phase is 271 units, all sold out. This shows another affordable housing project in Kasarani, Elma. We're currently on third floor of construction, and shell and core construction is expected to be completed in December. This is Bera Vista Apartments in Uganda, 360 units, scheduled for completion within the year end. And these are Apala Bungalows in Uganda, scheduled for handover in December. Shell and core is complete. We're just finishing the infrastructure segment. Our CFO will take us through the financial performance.
Thank you very much, Ken. You will excuse my my voice. I have a cold, but that's not withstanding. With that background that Ken has spoken about, he has alluded to the financial position of the company. So total assets as at the end of the year are 41 billion, comprising largely of Vipingo and Pearl Marina, where we have significant land banks that we continue to monetize, as he has spoken to. Then total shareholder funds of around 25 billion. That is what has been funding the operations of the business. That being said, I'll go straight into the reported performance. So revenue grew fourfold to 1.8 billion, and this is coming from the 300 units that were recognized in the P&L during the year. So according to our revenue recognition criteria, we only recognize the revenue once a project has been completed and the respective customers have paid in full what is due from them. So in light of that, from the 624 units that were completed, 300 met that revenue recognition criteria as of 31st of March, leading to that significant growth in revenue. This particular segment will continue to experience almost 3-digit growth rates in the coming years as more and more units are completed. In the current year, as Ken has spoken to, you've seen the progress of the various projects, and we are projecting that an additional 400 or so units will be completed, and therefore this will continue to grow. From a gross profit margin perspective, when you look at that, those margins are slightly lower, and it is on account of the affordable housing units that were recognized during the year. Those units tend to have a lower margin compared to the higher end units. And as a business, we are working towards improving those margins through improving and enhancing the supply chain, and also reducing the construction duration, which Ken will speak about in more detail in the outlook section. Going to the development rights business, Ken has alluded to the quantum of the transactions that were completed during the year, and so we recognized 1.7 billion in sales. These transactions, because the profits were recognized in prior periods through the valuations, they were executed at valuations that match the carrying value, and therefore do not have a huge impact on the P&L. But what they go to do for the business is convert that into cash, which goes a long way in funding the development program, the residential development program, and meet the debt obligations. So this particular segment of the business does not have significant impact from a performance perspective, but has huge implications on the business from a cash flow perspective, and you'll be able to see that a few slides below when you look at the cash flow statement and what the business is able to generate. Going down below that, we see the fair value gains, which have significantly come down in the current year. And the gains are from the valuations that have been carried out by an independent valuer, which are also informed by the valuations that we are able to achieve from actual transactions that we carry out in the market. So that is the resultant figure that arose from the valuation in the current year. So 500 million being near 70% drop from the current year of 1.6 billion. The operating expenses grew around 25% on account of two things. One, significant one-off costs that happened during the year following a reorganization and a restructure that happened. And also secondly, since the inventory, some of the costs that we incur are capitalized as part of the cost of the inventory as we build up that particular line item. As those units get recognized in the P&L, then that corresponding cost that was capitalized in the prior periods then starts flowing into the P&L. When you look at last year, that OPEX as a fraction of the gross profit from the residential program was slightly odd. Though in the subsequent periods, we expect that number to continue improving as more and more units are recognized in the P&L. We've put in place significant cost-cutting measures, which will start bearing fruit from FY23 and beyond. Management's intention is to bring down that operating cost figure to be around 30 to 40% of the gross profits. So that is a continuing journey that we continue on as the business grows. That being said, the business reported an operating profit of 650 million, which is down from 1.2 last year, and a loss after tax of 31 million, driven by those factors that I have spoken to. Going to the balance sheet, a sound balance sheet and financial position. Total assets of 41 billion are largely contributed by the investment property, which remains to be a significant component of the total assets of the business, around 28 billion. Very liquid at around 1.6 billion, and that is the cash that is coming from the collections from the residential program and also the monetization of the development rights in Vipingo and in Pearl Marina. From that, you see that the borrowings are reduced from a 6.6 to 5.8, which is roughly an 800 million drop, just a principal reduction. The deferred revenues, those refer to the customer deposits from both the development rights and the customer collections from the unit sales, from the residential unit sales. And so this is a moving balance. So as we collect, then the deferred revenues increase, but then as those numbers then translate into the P&L, then they reduce proportionately. So that also represents largely the deferred revenues from the projects that are in progress today. On a cash flow perspective, a very liquid business, 1.6 billion in closing cash. The net cash generated from operations, 1.4 billion, and a similar amount was used in financing activities, which means that the business is able to generate sufficient cash to fund its operations and also to meet its debt obligations in the year. So we continue to see this continuing. In the outlook section, Ken will speak about the development rights sales that have been signed and that we expect to continue collecting and receiving that cash. From our residential program, we have a very healthy receivable of around 8.2 billion that is performing well. Currently, our average collection rate per month is around 250 million, and we expect that to continue even as more projects are completed. The election jitters are notwithstanding, we continue to see how that will affect the business. On the debt, I'd already alluded to this. So a net borrowing of 4.2, and that's basically the total borrowing of 5.8 at the end of the year. less the cash that was sitting on the balance sheet at the end of the year of 1.6, 4.2 billion, being an 800 million drop from the 5 billion. When you look at that net borrowing as a proportion of the shareholder funds represented by the equity figure of 24 billion, the debt represents only 17% of the equity, which is an improvement from last year when it was 22%. The debt also represents roughly 10% of the total assets. So you have a sufficient coverage of that debt. And that debt is backed by very productive assets from both the development rights that we continue to sell and pay down that debt. And the other debt is the bond, which is supported by the residential projects that we continue to collect the funds for and meet our obligations as they come due. So in the next coming months or years, as we go, expect this debt to continue reducing significantly. That being said, in summary, an operating profit of 650 million, a sound balance sheet, total assets of 41 billion, a debt of 5.8 billion that is backed up by very productive and cash generative assets, as Ken has spoken about, and a very liquid business with 1.6 billion in closing cash. We expect going forward that performance to improve as the measures that we have put in place continue to bear fruit, especially from a cost perspective and from a project perspective, as more and more projects are completed and are recognized in the P&L. I'll hand over back to Ken to take us through the next segment, including the outlook. Thank you. Thank you very much.
Thank you, Solomon. So we invest in the communities where we do business. We impact those communities positively. So we have a scholarship program that Centum Real Estate does across the region. In Vipingo, we educate, now we've educated 300 bright and needy students who get full high school scholarship. And these kids would otherwise not have gone to school. During the year, we awarded 50 more scholarships, and these kids have joined high school, specifically national schools across the country, having scored 320 marks and above. We also have a desalination plant that is operational and generating water. We share this water with the community in the area that we are doing business. With the strong financial position that Solomon has presented, with a market that has a greater demand than supply, we are excited and optimistic about the future. And this future is really market driven. We have a huge housing deficit across East Africa. To be specific, in Kenya, the housing gap is over 2 million houses per year, with an annual demand of 250,000 units. But combined, the entire market is able to supply 50,000 units. So there is a market gap there. Looking at Nairobi, 90% of the residents are tenants, and just 9% are homeowners. Looking at our own investors, 90% of our investors of the investors who have bought units within our developments are looking for a rental yield, with just less than 5% being owner occupiers. The supply of these rental units, 87% is done by individuals, and 7% is done by private companies. So there is an opportunity there for Centum Real Estate to play into this market segment and deliver units and bridge that market deficit. Just a reminder, if you have any questions, please feel free to type. So our outlook is first, we are looking at the market demand. We've looked at the market gap, and we feel there is an unmet housing gap that across all cities in East Africa, that Centum Real Estate will position itself to bridge that gap and capture that market opportunity. In terms of residential unit sale, we'll focus on affordable and mid-market housing. We've really participated in all those market segments, and where there is depth of the market is in that market segment. We expect to complete over 300 additional houses in the next financial year, and also launch phase 2 projects across our sites. Just like Solomon mentioned, the margins are not as high. We are looking at enhancing that margin to create value by relooking at our design, reducing our construction timelines by adopting a formwork technology, and reviewing our supply chain. As you know, globally, the supply chain has been impacted. The Kenya shilling has depreciated against major currencies, and the logistics and supply chain challenges. So we're looking at procuring materials both locally and in the region, specifically Comesa region, where we can enjoy some incentives and pass those benefits to our customers. On the development rights, the attractiveness of our sites remain. We have a really strong and healthy pipeline that we are negotiating, and we hope to close significant sales in the coming year. Cash generated from development right sales will be utilized to fund construction of the residential houses and to meet our debt obligations as they fall due. This brings us to the end of investor update. We'll then take any questions that have been posted. Thank you for joining us. I think the presentation must have been very clear. No questions posted. We will, however, check and respond and post those questions on our website. Thank you. Have a good morning and a productive week ahead.